What's up, everyone? It's Kadi with MoneyVest. So in this video, I wanted to go over 5 areas in the market that can potentially explode going into 2024 as rates continue to come down, right? So yields have been dropping this past week. We've seen the 10-year treasuries drop pretty aggressively, which has sparked such a massive rally behind technology stocks, behind innovation stocks, behind a lot of, the markets have just been on a very nice technical rebound this week on the back of treasuries dropping. And that's something that we have obviously been waiting for a long time as treasuries have continued to go higher. We even did a poll this morning in our live stream asking everyone how many people believe that the 10-year treasuries have topped out and how many people believe that they're going to go higher beyond 5%. And 2/3, over 67% people believed that they have already topped, and 1/3 believe that they are going to go higher. And right now, they're once again sitting down at as low as 4.6, 4.5%. We'll take a look at those. And I'll also highlight how the markets have shifted a little bit. The expectations have certainly changed in the last 24 hours. And now 5 areas in the market that I do believe have a lot of potential for just significant, potential gains here. So hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like. All I'm asking in return is that you drop a like and, of course, subscribe to the channel. I would really appreciate it. We're trying to get to 100,000 subscribers by the end of this year, so 2 more months left. And I would really appreciate your support. And links to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the members-only benefits, including members-only private videos, trading view charts, intrinsic value spreadsheets. There's going to be a lot of stuff included with the link down below. So this right here is a quote that I wanted to run through first by John Maynard Keynes, one of the greatest economists of all time. And he says, and I quote, "Markets can remain irrational longer than you can remain solvent." And this is such a beautiful quote because it kind of helps us better understand that at the end of the day, when it comes to long-term investing success, half the battle is staying in the game, right? Because the other half is obviously finding alpha and generating, better than the market expected return. But half the battle, I would say even more than half the battle, is staying in the game. Okay? And a lot of people, even including businesses and investors, it's a big challenge because markets are, very, very dynamic in a way that they move. There's so many variables at play. There's so many things to look at and analyze that oftentimes we get distracted, and oftentimes, we forget that this is a long-term game, that this is a game that, we are playing over the next several decades, to come. And it's not just a game for the next quarter or for the next few months. And right now we're kind of going through a time period where interest rates are high, and whoever can survive this downturn of higher interest rates, and I talked about this in our live stream this morning, that we're kind of heading into this environment where there's going to be dark clouds. Like dark clouds are now appearing, right? Think of yourself as walking through a path, and there's dark clouds now appearing because we got the unemployment numbers this morning. Jobless claims came out earlier this week, and those are now starting to show signs of some softening in the labor market. Those are, again, showing signs of a potential recession in the U.S., either early, at the end of this year, early next year, and that's the dark cloud. Now, whether it's going to start raining, meaning whether we are going to actually go into an economic recession, time will tell. But half the battle, very, very important stuff, is to remain in the game and not get blown out when it starts raining, when it starts getting challenging, it starts, very, very windy, things like that. Half the battle is staying in the game because markets can and will remain irrational for longer than we can stay solvent. So if you do have a decision, if you do have, a sort of like a thesis in mind, we have to progress slowly and steadily with patience, and not jump right back in with both feet. So take it slow, take it easy. Yields coming down, that's a good thing for the market. That's exactly what we want to see because that's resulting in borrowing rates and risk-free rates to come down. That's good for equities, and that's what we're seeing right now. Now, this right here is the unemployment rates. Unemployment rate ticked up from 3.8 to 3.9%, with the non-farm payrolls coming in at about 150,000. And manufacturing payroll, that was a big change here. 35,000 jobs lost in the manufacturing sector. Now, manufacturing and construction, 2 very, very important sort of like categories within employment, because that basically suggests production and creation of goods and services, right? Manufacturing and construction basically is building stuff. So if we are not hiring people in those two categories, that does start to suggest that, okay, the economy could come to a halt or start to pull back faster than what the data is suggesting. So that definitely is coming in way above expectations of negative 35,000. Unemployment rate also ticking higher. Well, because of that, market is now expecting 4 rate cuts in 2024. So this has significantly changed in the last 48 hours since we have got unemployment numbers, since we've got the Fed meeting. Earlier we were expecting 3 rate cuts with some possibility of a rate hike. And now the market's pretty locked in that, look, we're going to see a rate pause. The Jerome Powell is bluffing. We're done. We're not going to see any more rate hikes in this year. And 3 more meetings of keeping the rate steady. In other words, rate pauses for 3 more meetings. And then starting in May is when the market's pricing in for rate cuts to begin and for 4 rate cuts to happen in 2024 till December of next year, and coming down to 4.25 and 4.5%. Now, time will tell, like I said, whether the Federal Reserve is bluffing or not, and whether they are determined to keep raising interest rates or keep them higher for longer, or whether the market is indeed correct in pricing in a rate pause and then rate cuts 4 times next year. Time will tell. But I'm here to go over opportunities in the markets that I think we need to be ready for, because if there is, let's say, a recession that eventually rates do get cut, there's specifically few sectors that are going to offer significant amount of opportunities. I mean, NASDAQ here on the day up over 1.3%, S&P is up over 1%, the Dow Jones pushing up over 80 basis points with the yields dropping over 2.66%, and how quickly we dropped almost 50 basis points. I mean, just a few days ago, we were at almost 5%, and now we're at 4.53, right? So we're definitely dropping quite a bit, and that's obviously creating a lot of opportunity in the market, more specifically small caps, which is going to be part of the list. So this is the past 1 week for the market, right? A very strong recovery, very strong technical rebound. But there are still certain levels the market needs to take out in order for us to see any type of confirmation that this is going to be longer lasting. And what I mean by that, if you come over to the S&P 500, take a look at that week. I mean, just absolutely incredible. Up over 6% this week. And now we're coming up to that resistance. So if you come over to the daily chart, you'll notice that we are coming up to that resistance now perfectly. So 4, 5 back-to-back green days for the market. And we're coming up to this lower high. So very, very important resistance, folks, that we're coming up to now. And this is really going to be the make it or break it type moment for the bulls and the bears. And whether we take out this resistance is really what's going to dictate the next couple of weeks. We've got inflation numbers coming out very soon, whether we see more upside or we get rejected here. Same thing happening with the NASDAQ. And you can see that we are coming up to that resistance of that lower high. So this right here is going to that level where the NASDAQ is going to start to kind of hit up on some resistance and some sellers. And it's really going to dictate whether we break out or not. Now, 5 sectors, let's just dive right in. So first of all, discretionary stocks, right? These are your electric vehicles, solar, semis, companies that are dependent on interest rates being lower. As we have learned with Enphase, with Tesla, as rates have continued to go higher, it's become more and more difficult for people to finance their purchases when it comes to solar inverters, micro inverters, solar panels, electric vehicles, even hardware goods like MacBooks and iPhones, and the demand for that has been slowing down, and as a result has also affected semiconductor stocks. So any type of discretionary spend is going to benefit if rates are lower. It's just demand and supply, and it's just logical, right? If interest rates are higher, people are not spending as much money on this stuff. If interest rates are lower, money is cheap, so they're able to spend money on those things. So demand goes up, demand goes down. It's pretty logical. Next, small cap stocks. We've talked about this. We talked about it in our live stream as well. IWM. Take a look at where we are on the day. Up over 2.8% on the week. This thing is up 7.5%. Outperforming the S&P, outperforming the NASDAQ. However, down year to date, so still down over 0.71%, so basically flat on the year so far, and it's now trading at a very nice support. So this right here is a technical level where it's kind of bounced off of several times in the past, and the resistance going to be all the way up here, sitting at 198. So we still have a little bit more upside potential, in my opinion, for IWM sitting all the way up to 198, close to $200 per share. But this is the reason why small caps benefit in a lower interest rate environment. Again, she'll be self-explanatory, but a lot of these companies have financed a floating rate debt. These are also companies that are not profitable. So over 60% of them are not generating any type of net income or profits or cash flows. So as a result, higher interest rates do affect their ability to continue their operations, right? So going back to that quote, markets can remain irrational longer than you can stay solvent. So it's really kind of having an understanding that, okay, once interest rates are back down, once we go through that recessionary period, which companies are going to be holding their ground steady and which ones have the highest potential. But IWM, small cap index ETF with over 2,000 stocks, certainly has a lot of potential in my opinion. Now, there's also potential for short squeezes, right? So lots of companies that are going through a lot of short selling activity, companies that have been shorted along the way. For example, DraftKings up over 17% today, Square's up 12.5%, Roku's up over 9%, Fubo's up over 10%, Upstart's over 9%. It's kind of giving you those vibes of 2020, 2021 again, where there was, significant moves in double digits intraday for a lot of these companies, right? AMC's up over 6.5%. So that's another area of the market, which is like a lot of companies that are being heavily shorted can start to see some covering, and that's going to release some of that squeeze back higher for these stocks. The bond market makes a lot of sense, pretty logical, right? If yields continue to drop here, you can see a lot of momentum back higher for TLT. For example, this week TLT is up a little bit over 4.89%. We haven't seen such a strong week in TLT in such a long time. And TMF this week is up over 14%, almost 15% so far, up almost 4%, trading up to 470. So there is, like I said, there is potential if yields continue to drop. And this, again, a lot of this is hinging on the idea that rates drop and they keep dropping. If we see this week the treasuries are down, a little bit over. So if you come back over to the 10-year, we're lower a little bit over 6%. So this is the sell-off that we're seeing in treasuries. But next week, they're up 11% or 12%. And of course, we're going to revert back to the, a couple of weeks ago when, of course, markets were selling off. But this is kind of hinging on this idea that yields continue to fall further. Now, high growth and tech innovation stocks are also going to benefit, right, from rates dropping, like ARK stocks, ARK Invest and Cathie Wood stocks. And if you take a look at ARK Invest this week, is up a little bit over 19%. 19% of outperformance this week compared to the NASDAQ, which is up like 5-6%. So a significant amount of momentum coming in for these types of stocks here. And of course, we've got IPOs and SPACs and cryptos. Like these are all risk on assets, risk on environment in the market that's going to be on the back of dropping yields and lower rates. So that's where we are. Let me know your thoughts down in the comment section below. I am a little bit more risk averse, so I did add a VUG yesterday on the back of this rally, and I do expect there is potential maybe for us to see a bit of a breakout, but a lot of the detailed technical analysis with market breadth and volatility will be discussed in our Discord and our Patreon. So again, if you want to get access to all that type of analysis and research, links going to be down below, and we'd love to have you on board. As always, happy investing, and I'll see you all in the next video.